So without further ado, I'm going to hand over to Richard Brandweiner. So Richard has over 20 years working across all asset classes in the funds management industry and superannuation industry. He's currently the Chief Executive Officer of Pendal, formerly BT Investment Management Australia, for those who have been around a little bit longer. Pendal is one of the leading Australian independent fund managers. Prior to this, Richard was a Chief Investment Officer at First State Superannuation and Group Executive at Perpetual Investments. Richard doesn't have any slides for today, so your system isn't broken. And without further ado, then over to you, Richard. Thank you for your time.
Thanks a lot, Brooke, and good morning, everybody. Thank you very much for making the time today to talk about sustainability, which is, I guess it's a particularly relevant topic for so many reasons, not just because of what we've experienced through bushfires, floods, then famine, and the perspective that the economy is so intrinsically linked to these broader ecosystem events and in fact our behaviours, but also because regulators around the world and people are starting to evolve and adapt and change the way that they're looking for things. People are starting to buy goods and services. Your clients, yourselves, are starting to buy goods and services based not just on what a company does, but how they go about doing it. And these are fundamental shifts in our psyche that I think are underpinning a wholesale move towards thinking about, how we invest as well as everything else. So there's a few things I thought I'd do today before we hand over to Tony a bit later on. And what I'd like to do is just to take you back on the journey of how we've got here, how we've evolved in the investment profession from ethical investing all the way now to impact investing and what that journey looked like. Then I'll give you some thoughts about how we at Pendal are adapting to that and have adapted to that over many years. And then put that in a little bit of perspective around, what does the end of that arrow, the pointy bit, positive impact actually look like. So this all really started many years ago with ethical investing. And these terms are used loosely and differently by different people. So hopefully this will help you make some sense of it all. Pendal, BT back then, launched its first ethical fund back in 1984. And the idea of ethical investing was very much about values. It was values-based. It was mainly church-based or faith-based groups that would invest in ways that were aligned with their moral code or their values. And it was really about screening. It was about not owning tobacco, not owning gaming, not owning, all sorts of other types of companies that do harm. And then this movement grew in the sort of first part of the 2000s around the concept of externalities. And I'm sure you're all aware of it, but just for those of you who are not, it's an economic concept. And it's basically that, you do something and there are second and third order effects of that affect the broader ecosystem. And the best sort of story about externalities was the tragedy of the commons, which was first talked about in the early 19th century by an English economist. And it was basically, if I graze my cattle on common land, it's in my interest to put another cattle or steer on the land. But if everyone acting in their own best interests did that, the external impact of that was the devastation of the land for everybody. So there's a conflict there between your internal motivations and what was best for society and ultimately for you in the long term. And so externalities became, we recognized that pollution is an externality. We recognized that in your supply chains, you generate externalities. Even through employment, you generate externalities. And little by little, as we became more sophisticated, we understood that you could measure those externalities and that they weren't free. They were being borne by society. And in fact, as regulation evolves and as we became more aware of them, the reality is that they would end up affecting your earnings over time. as regulations shifted or consumer demand changed, and that would ultimately lead to a change in your cost base. And a good friend of mine from overseas, from Willis Towers Watson, the asset consultant, wrote a really wonderful article that said past performance is not even a good guide to past performance. And what he meant by that was that the performance of stocks or securities over the last however long is not fully reflective of the true intrinsic earnings of those companies, because they didn't factor in a lot of the externalities that those companies were generating. So a good example is tobacco. So tobacco was the best performing sector of any sector in the world over the last century. Now, I don't think that will be the case over the next century. And the reason why it was that as a society, we didn't understand the externalities. We didn't understand the impact of the products that were being sold. And so we weren't factoring that properly into an assessment of the companies. So the United Nations Principles for Responsible Investments grew, and the emphasis on this new idea, ESG, environmental, social, and governance, became an idea around risk management, long-term risk management. It recognized that if these externalities are real, and if we expect that over time they will be increasingly factored into the price of securities, then we should start thinking about them as investors now. Can you see, it wasn't about values. It wasn't about what I believe is right or is wrong. And that was the evolution from ethical investing to ESG, which was really, in its early incarnation, about long-term risk management of making an investment decision. But then things evolved another step, and we recognized that these externalities, these second and third order impacts, were real. And then people started to say, well, maybe I can build a portfolio in a way that is more sustainable, recognizing the impact of these externalities. Maybe I could have a sustainable portfolio. And maybe that sustainable portfolio does the ESG risk management. It's mindful of how things are going to change, and it factors that into the pricing of securities. But maybe what it also does is bias the portfolio towards more sustainable companies or more sustainable sectors over time. Now, why might you do that? Well, there's two reasons you might do that. One, you might believe that actually there's an alpha source there. You might believe that actually those sorts of companies will perform better over time because in consumers, as their behaviors change, will be more attracted to them by their products, and that companies in industries or in their behaviors that are less sustainable will actually do worse over time. The other reason, of course, why you might invest that way is because you believe that you want your capital to be invested in positive ways. And that is happening more and more. And interestingly, I mean, sustainable investing is one of the fastest, if not the fastest growing part of the investment management universe. And I think about 9 out of 10 Australians in recent Roy Morgan research have said that they expect their investments to be managed in a sustainable way. And so that is something that we really can't ignore. But there's a final step to this, and that is impact. And impact is about investing in ways, recognizing those externalities, but then deliberately building a portfolio that is targeting the creation of positive externalities. So it's no longer just about, is this a sustainable company in a sustainable industry? It's about recognizing that the goods and services that companies actually do can generate very, very positive and profound outcomes for the world. And impact investing is about targeting those sorts of investments and then measuring what those outcomes are, broader than just the financial returns of the company. And to me, impact investing is the point of the arrow. This is the bit where we actually recognize that capital has real power, and that all of us, financial advisors, fund managers, asset owners, are actually in a very unique position, a position of responsibility, a position to operate as fiduciaries, to actually recognize that the way they invest does matter. There is a purpose to our financial system. The purpose is not money in its own right. It's not an end in of itself. The purpose is actually to channel capital towards productive enterprise and actually to create our future. And there's about $130 trillion globally that sits in pension funds, super funds, sovereign wealth funds, advised by financial advisors, fund managers, insurance companies. That's almost 2 times global GDP, annual global GDP. And that money, the way that money is invested, will help shape the world that your clients and you and me will retire into. And in my mind, that makes this space that we're talking about today hugely important for us as fiduciaries, advisors, and allocators of capital. So that's the journey. And the journey is about, I guess, our growth in the system. Our growth as investors, as almost as humans, recognizing that the world is not two-dimensional. The world is a complex, adaptive system. And, we will become more and more smart the more we think about how different things impact other things. And you can see this as the third axis. So if you like, in the beginning, there was one axis. The first axis was returns. Advisors, ourselves, back in the 1940s, 1930s, 1950s, only really spoke to our clients about the returns that we generated. And then with modern portfolio theory, the idea of risk emerged. And now we have 2 axes, risk and return. And it's madness for us to think about to not think about return without being cognizant of how much risk we're taking to get that return. Now, it was always there before, we just didn't measure it. And so now we realize that there is a third axis. And the third axis is the impact of whatever investment or company or government that we might lend money to. And it was always there, but we didn't measure it before. And increasingly, we're starting to measure it. And so at Pendal, what we've done is, as I said, we've been in this space for a long time. And in the 1990s, we started working with Monash University in Melbourne to think about the impact of environmental change on company earnings. And that research back then has actually grown into an organisation called Regnan. And Regnan is one of the leading ESG research and engagement providers in Australia. Recently, we bought out our other partners who were superannuation funds to bring Regnan in-house and bring it a lot closer to our investment decision making. And part of what we're trying to do with that is to grow the impact investing space and actually use Regnan and its research as the foundation for thinking about the impacts that we generate as investors. We recently launched a product called the Regnan Credit Impact Fund. And what that fund does is it lends money to investment grade borrowers, governments, supranationals, as well as corporates. And all the money is lent to green and social bonds. So we measure the outcomes of all of that lending that we do. So to give you an idea, it's only small, we've seeded it ourselves with $30-odd million, but that portfolio right now is taking something like 13,000 tons of carbon dioxide out of the atmosphere on an annual basis. It's restored 60 hectares of forests. It's generated 16,000 megawatts of renewable energy a year. It's provided 340 jobs. It's created 50 loans to female-owned micro enterprises. And all of that with high quality investment grade credit, paying, it's the current spread to the cash rate's about 110 basis points. So you're getting liquidity, you're getting high quality investment grade credit, and at the same time, these externalities are being measured and targeted. And for us, that's a huge leap. So I might hold it there and then invite Tony to talk a little bit, and then very, very happy to take any of your questions, and we'll be back to have a discussion shortly. Thank you.
Thank you, Richard. Greatly appreciated. That was a great recap where, well, the evolution basically of the responsible investing style over time. Where we've been and where we're going to. We're now going to move on to Tony Adams' presentation, our very own Head of Sustainable Research here at Lonsec. Tony joined us at Lonsec back in March 2019. He's currently responsible for the responsible investment subsectors across the various equity teams as well as fixed income, and has a broad oversight of the ethical process, ESG, impact investing across all the managers that we review. Prior to joining Lonsec, Tony has had 30 years experience in global fixed income markets, most recently as the head of global fixed income and credit at Colonial First State Global Asset Management, where he developed the firm's global credit capability and oversaw the implementation of ESG across portfolios. So he's well versed to be able to talk on this topic. Over to you, Tony.
Thanks very much, Brooke. I'm assuming you're not going to hear me. There's a lot of different words and the different phrases and different language used in this whole world of ESG and responsible investment. And I thought what might be a good way to start would be just to clarify, particularly the way I think about it, but the way Lonsec looks at what ESG is and what it isn't, and explain, I think, where some of the confusion around ESG has come from. And it really comes down to the lens through which people think about ESG. So ESG being environmental, social, and governance risks. If you're a fund manager, and this is almost the entire case, it's not probably 100, but it's close to 100%. When a fund manager thinks about ESG and environmental, social, and governance risks, what they are thinking about is, what are these risks and how might they impact the value of the company I'm about to invest in? So will these risks manifest in a way that might impact the future share price or the future credit rating or the future spread or the future return from this investment? So they're thinking about it and looking at it through the lens of the value of the firm they're investing in. For the rest of us, and for probably, I imagine, most of your clients, when they think about ESG, what they think about is, what are the environmental, social, and governance risks as they pertain to me, or my society, or my family, my planet, my kids' future, my grandchildren? So the lens through which they look and think about these risks are far broader than the way a typical fund manager is looking at these risks. And I think this is why we're getting a lot of disconnect between ESG as fund managers are often presenting it and ESG as clients and advisors and investors are looking at it. So I think if we continue to keep in mind these two different lenses as we go through this conversation, it might make things a little bit clearer. Can I go to the next slide, please? So ESG, which I will go into a little bit, is really important. And Lonsec, there's a statement here which you can all read, but Lonsec believes that ESG, that the assessment of environmental, social, and governance risks by fund managers in their investment process is likely to improve either risk management or returns. And as a result, fund managers have a higher level of ESG integration, are more likely to deliver to their investment objectives. So what we've done is we've brought our ESG assessment more clearly and more defined into our rating process. So ESG analysis will become part of, is becoming part of the checklist of factors that we look at when we rate an investor, a fund manager and a fund. The next slide, please. So it's important to really understand, as I said, what ESG means, particularly as fund managers use the phrase, and the way Lonsec is looking at the phrase ESG, and I'll get to sustainability in a moment. But ESG is an investment approach. It's a way of looking at and thinking about your investments. It's a way a fund manager considers the environmental, the social, or the governance issues as a broad part of that investment approach. And there are many ways that fund managers do this and can do this. And they're all quite legitimate different approaches. But what they are doing is thinking about environmental, social, and governance risks as they make an investment decision. And they're thinking about what those risks might mean to the future value of the company. So it's understanding the risks and in some cases the opportunities. It's also about engaging with companies. And Richard mentioned, what Reedman's been doing, but it's really around talking to companies as a shareholder and as a fiduciary, engaging with companies, talking about their risks in a two-way dialogue, really understanding the risk, helping investors understand the risks, but also engaging with companies around what sort of risk management investors might expect to see. ESG is also about voting. It's also about expressing your opinions and your views when you vote and thinking about the environmental, social, and governance risks that a firm is taking when they're voting. So ESG, from a fund management perspective, is around how do I think about making this investment or not. What it is not, it's not going to tell you what the ultimate investment decision is. A fund manager who is looking at a whole range of risks when they invest in an asset, financial risk, competitors, they're looking at environmental risks, they're looking at what the product's like. There's a whole range of things a fund manager looks at. ESG doesn't tell you what their decision is going to be. So it doesn't tell you anything about ultimately what the portfolio structure is going to look like. It's not an outcome. So it doesn't guarantee that you're going to end up with an environmentally positive portfolio or a socially positive portfolio. It doesn't guarantee you have an ethical fund or a green fund. So it's not an outcome. ESG is a process, not an outcome. And it's certainly not about exclusions. ESG is not about saying we're not going to invest in tobacco or we're not going to invest in coal mining. Those decisions happen, but that's quite a separate process, and that's either coming from an ethical or other sort of lens. So ESG process, not an outcome. I'll have the next slide, please. So because ESG is thinking about investment process and not really looking at, well, what is the outcome? What does the portfolio look like? Lonsec has seen the need to build a new series of reports, and this is what our new sustainability reports are. Because managers are implementing a whole range of different approaches to ESG. Now, they might look at a coal mining company and say, look, I understand the risks. I understand the risk of asset stranding. I understand the risk of climate change and government regulation. But I'm going to buy it anyway because I think it's cheap enough. Or I think this is one of the better coal mining companies from an ESG point of view. Or I think that ESG might get better. So there's a whole different range of reasons that managers might buy a coal mining company, whatever. So ESG in itself is not delivering the portfolio intuitive outcomes that clients are expecting. And as I mentioned, being a good ESG manager does not mean that you're delivering an ethical, sustainable, or green portfolio. There is still greenwashing in the industry. I don't need to tell you all that. And there are brand labels and there is confusion around the labels. So what we need to do and what Lonsec's done is built this new sustainability report, which doesn't look at how the portfolio manager makes their decisions, but looks at the decisions, looks at the portfolio and tries to measure how much goodness is in this portfolio. I know that's probably not a real word, goodness, but it's a measure of how much goodness is in the portfolio. And the way we've done that is twofold. We've used the Sustainable Development Goals as our base, and firms that build products and services that contribute to solving and assisting with the Sustainable Development Goals are good. Contributing to controversial industries whether that be tobacco, carbon, whatever it might be, are not good, and we sort of net those two together to come up with a single measure of goodness in a portfolio. So whilst ESG looks at process, what we're looking at here as well is outcomes. I'll get the next slide. So the Sustainable Development Goals, and I'm sure most of you have heard of these, but these really are the framework that is being adopted now and being used across a whole range of governments, investors, NGOs. Most of your kids will know about the Sustainable Development Goals. And this is really a blueprint, and it's a blueprint for developing a better planet and better lives and outcomes for people both now and in the future. This is certainly not the only way to measure goodness in a portfolio. This is the approach that Lonsec's taken. I'll get the next slide, please. So what we've done with this whole responsible investment space is made two clear different product or there's processes, if you like. The first is going back to ESG. So we are looking now at a fund manager's ESG process as part of our investment rating process. So we're looking at against the principles for responsible investment. We're doing a whole range of questionnaires. We're doing desk research. We're interviewing the managers. We're combining all these and incorporating the outcome of that into our investment rating. So when you see a recommended or a highly recommended or investment grade, we've considered that inside that part of that process. So we're capturing that because it really does reflect on how they make investment decisions. We continue to show this in iRate as our ESG biometric, so you can certainly look separately for fund managers that have high or low ESG scores from a process point of view. In addition to that, though, we've built our sustainability reports and sustainability scores, which will look at the portfolio. And these are the ones measured against the Sustainable Development Goals, combining good contribution to global good, offset that against controversial industries, and come up with a separate report and a separate score. We're building a supplementary report, and that's now available in iRate as well. I'll get the next slide, please, to give people an idea of what they're looking for. We're actually using bees. I think everyone's aware of the importance of bees in biodiversity on this planet. So we're using bees as our scores and giving managers a sustainability score. Now, this is a peer-ranked score within the asset class that we're looking at. So we've just published a number of Australian equities portfolios. Pardon me. We'll be rolling this out to other asset classes as we go forward. But what we do is then look at each of these managers within, say, the Aussie equity sphere and rank them. And a 5B score is going to give you the top 10% of net goodness in the portfolio. So we're really hoping that this additional report separating ESG from portfolios and giving a clear, clean report on, well, what is the outcome, what is the sustainability score of this portfolio, will help your investors, your clients, sort of see through this world of murky language. I might pass back to Brooke at this stage, and then we can move forward into the next stage.
Excellent. Thank you, Tony, for providing a little bit more clarity around this somewhat murky topic of RI in terms of what the terminology is or isn't. Excellent, Richard, you've come back. So we're now going to have a somewhat structured panel session for the next 20 minutes or so. Please do continue to send through your questions, and we'll answer those in the Q&A session for advisors at the end. So I thought the first question I might actually hand to you, Richard, if that's okay. There's been lots of talk about ESG. Perhaps we start talking about the E in ESG in terms of engagement. and where that sits within the ESG framework.
Okay, so well, E is an engagement in the ESG, but it could be. So the ESG stands for environmental, social, and governance risks, and Tony did a great job of sort of explaining that those are not meant to be values based. They are meant to, when they're factored into an investment decision making process, they're about, you know, what are these long-term non-financial risks in the short term, but ultimately financial risks in the long term. And what you tend to find is that governance has been one that has been focused on for a long time. Increasingly, people are mindful of environmental risks, and the data around environmental risks is getting much better. But then social risk is, of course, you know, hugely important, and you can see it with things like the Modern Slavery Act, which has just come out, which will be law very soon, raising the bar on companies and investors to factor that sort of risk assessment in their investment decision-making process. But Brooke was really talking about engagement and just how important that is. And, you know, in my mind, this is really the defining characteristic of active management, which is stewardship, which is the idea that it's true investment as opposed to speculation. You know, when we make a decision to invest in a company, we are an owner of that company on behalf of our clients, you and your clients. We are a steward of that capital, and we need to hold management of that company to account, because if we're not doing it, who is? And, you know, I don't think we can assume that it will all be fine. And so engagement is a huge part of what we do as a fund manager, as an active fund manager. To put it in perspective, I think, you know, in the last sort of 9 months, we probably would have done well over 250 individual meetings with company management to challenge them on issues that relate to how they're managing that business. And we're pushing for change that we think is going to improve the quality of that company and ultimately actually improve the quality of the beta of the market. We sort of call it better beta, if you like. And in some respects, it's the externality that we are creating. So I've got a couple of examples here which might help. One that we're very proud of, there's a REIT and a listed property trust called Arena. They had no women on the board. We are a huge believer in diversity across organisations, but particularly at board level. We believe in that anyway, as you can imagine. But it was a particular issue for this company who had a lot of assets in female-dominated industries like healthcare and child work, and it went to problems of culture. And so we threatened to vote against their remuneration report. We did vote against their remuneration report. We actively followed up a number of times with that company, and now we're pleased to see them actually change the structure of the board and bring women on board. Closer to home, Westpac, you know, you saw the Austrac breaches there. Huge issues that go to risk management, go to culture, go to board accountability and management accountability. And you know, I guess for some of the major issues that we addressed with them were how the impacts on culture, the results of culture, but also how the board was handling decision making as it was under the public scrutiny that it was. And you know, I think we can tell you that we really believed that the position of the CEO was not tenable, and we made that very clear with management. Very sadly, with the board, very sadly, you may have recently seen in the press about Rio Tinto and the destruction of some Indigenous sacred sites, which they blew up, in effect. We've been taking that extremely seriously. We're spending a lot of time during this coronavirus period meeting with the chair and other members of the board. The issue for us is the internal processes that led to that outcome. We've been pushing for an independent inquiry. We want all of the terms of that inquiry made public. We want the outcomes made public. And we feel very strongly that this is not something that, as a steward of capital, we can let go. There is a lot of value that's been proven to come out of this idea of ESG momentum, which is actually owning a company whose ESG credentials might not be that strong, and then engaging with them to improve them over time and to actually benefit from the re-rating of that company. Now, clearly, those sorts of organisations are not going to be the ones that you might want to hold in a 5B rated portfolio, but actually you're generating a lot of public good through that as well. So hopefully that helps, Brooke, just a sense of engagement, how critical it is.
Yeah, definitely, Richard. Greatly appreciated. I mean, there's certainly the E, or engagement, is certainly part of all the E, S, and G. Tony, maybe I might just get you to see how engagement as part of an ESG process fits into the sustainability score framework, or the results in the NBs.
Okay, so the engagement part does not come into the Bs at all. The Bs is what stocks are held in the portfolio. So it's purely a review of what are the stocks, what are the goods and services that the company makes, and how are they used, and are they used for good or not so for good. Engagement, though, is a very important part in our assessment of a manager's ESG approach. So when we're going through the ESG part of the process, looking at how is a manager engaging. Now, we're not really looking at the specifics or the outcomes of any particular one engagement, but we are looking for, is there a systematic approach to engagement? Is there a recording of engagement? Is there a link between engagement and voting? And importantly, as an investor, can I go onto their website or whatever and see what the engagements are and their outcomes? How are they reporting it? So we're really looking and assessing the transparency of their engagement process. A lot of engagement, of course, is done behind closed doors, which is a little bit, incongruent with the whole idea of improving transparency, but sometimes necessary. So we're really looking at assessing, as part of our ESG process, one of the key factors is, what engagement policy and approach does a manager have, and how transparent is that? So it's an important part of that ESG assessment process.
Excellent. Thank you, Tony. You spoke about ESG and sustainability in your presentation, Tony. Just wondering where ethical investing or responsible investing fits within all of this.
Yeah, thanks, Brooke. There's a lot of labels and a lot of terms, and the way I look at it is that responsible investing is the umbrella term that covers everything. It's everything. ESG, it's ethical, it's sustainable. It's the term that's being used broadly as the umbrella term. Now, it's not overly helpful because it describes both process and outcomes. Ethical investing, of course, is clearly, as Richard was highlighting earlier, is about exclusions. And it's about starting off with exclusions and saying straight up, I'm not going to invest in this, that, or this because of the ethical approach that I'm prepared to take, or I want to take. So the ethical decisions does not, in our mind, come into an ESG process. And it's also not something we're directly measuring in our sustainability reports, but of course, indirectly, if you're a fund that is not investing in a whole range of products that are deemed to be controversial, whether they be tobacco, alcohol, gaming, then you're going to end up with a lot less net badness, if you like, in your portfolio, and a better sustainability score and a better B rating. So it's not us making a value judgment that says we agree with that filter, we don't agree with that, we like tobacco, we don't like tobacco. The various managers can do that themselves. What we're then looking at is, well, what's the output? What's the final portfolio look like, and how much goodness is in that portfolio? By definition, I guess, if you take a lot of badness out, you're going to end up with a lot of net goodness. So a truly ethical fund should end up with a pretty strong ESG score.
Excellent. Thank you, Tony.
A really strong B score. I've got myself confused now. B score.
Good, all good. Richard, as a product provider at Pendal, then you guys have ethical, sustainable, and now impact funds available. Is that kind of where you draw the line between ethical, sustainable, and impact, or are there some nuances?
No, I think Tony did a good job explaining it. So I concur with all of that. Another piece of language which might be helpful is we have an ethical fund. We think of that as a do no harm fund. So that takes our existing strategy and then puts the screens on that that Tony talked about and excludes a number of sectors that are deemed to be controversial. When we start getting into sustainability funds, then they're biasing their exposures to businesses that are more sustainable in their in either the way they manage their business or in the products and services that they do. As I said, in my mind, this all leads you towards ultimately impact, which is actually measuring the impact that a company has in the broader ecosystem and recognizing that it's not just the company doesn't exist in isolation. It actually creates both positive and negative externalities. And actually, to Tony's point, one of the tricks in impact investing is thinking about the net impact that a company has, because we all by flying around the world, we're obviously generating emissions. But hopefully we're doing some good in what we're doing. And so what's very important in the science, if you like, and there's a bit of art in it too, around impact measurement, which is a big growing field, is actually to think about the net impact that an investment that you're making might be able to generate. And obviously going for positive net impact.
Excellent. Richard, another one for you. Pendal excludes a number of controversial industries within Pendal's range of products. Just wondering if you could outline what those are and what were the drivers behind their exclusion.
So I'll give you an idea. Thank you, Brooke. So I built my first ethical fund together with my boss back in 2003. And as I said, at Pendal, we've been doing it since the early 80s. And I think what's really important is that we are not, we don't want to impose, our particular moral view on anybody. In the institutional market, we do a lot of tailored mandates for different organisations where, they might have particularly strong views about certain sectors or certain types of companies, which we would exclude. When we're talking about a managed fund that's open to, a broad range of investors, what's important for us is to make sure that there are a series of screens that would make someone who's conscious about how their capital invested generally comfortable. And by the way, views on that do change over time. So to give you a sense, in our Sustainable Australian Share Fund, we exclude alcohol, gaming, tobacco, weapons, uranium as it applies to weapons, pornography, fossil fuel producers, as that's based on what a company does. And then there are a whole series of exclusions based on how a company operates. Are their practices poor? So things like, do they have poor record with regards to human rights, climate change, wastewater management, corporate conduct, labour standards, corruption, bribery, those sorts of things. So you add all that up together, and that is effectively a portfolio of exclusions. And then our challenge is to identify companies that are generating positive outcomes or behave in particularly sustainable ways. It does change over time. Uranium's an interesting one. Many years ago, all of uranium was usually excluded from strategies like this. Clearly, uranium is very, obviously can be used for munitions, which is unconscionable. It's also terrible waste product, but at the same time, it's green energy. So there's an active debate around that. In our sense, we tend to exclude it all.
Excellent. Maybe I'll hand that one over to you, Tony, in terms of what Lonsec's view or how is uranium handled within the B's framework.
Yeah, so again, we're not making decisions on whether something should or shouldn't be in a portfolio in the Bs. framework and in the sustainability report, but we have identified, I guess, 10 controversial industries, whether they be fossil fuels, alcohol, tobacco, uranium mining, and we do use those controversial net off against the goodness in a portfolio to come up with a score. We needed to do something to come up with a single score. But what we're really trying to do with these reports is just give investors the information they need about what's in a portfolio. And uranium is an interesting one because for a number of Australian companies are involved in uranium mining, Rio and BHP predominantly. For both of them, it's a relatively small proportion of their total revenues. And so often these companies will be bought in portfolios, even those that have a no uranium filter on them, because it's deemed to be such a small component. So we're not trying to say that that people should or shouldn't buy these companies. We're just trying to point out through the reports, hey, if you're owning these companies, there is a little bit of uranium in them. And you as the investor can make the decision on whether that's the type of portfolio that you want or not.
Excellent. Thank you, Tony. Think about sustainability and the UN's 17 Sustainable Development Goals. I was wondering if you could expand a little bit on those goals, or maybe touch on one or two of them.
Yeah, I mean, the Sustainable Development Goals are a framework that have come from the United Nations, and all the major countries in the world, almost every country in the world have signed up to this blueprint, if you like, as a way of improving and looking after people and the planet, and looking after them both now and into the future. It's important to understand that these goals are not really goals for companies. They are goals for governments and for policy and for strategy. But more and more companies are seeing that by aligning themselves with the way government policy is going to go in the future and the way government policies are being framed, they can see this as potentially a growth opportunity. But it's a solid framework for us to then look through a company, look through the goods and services, and see whether and how the goods and services are being used and to what extent they're contributing to sustainable development goals. So it's clear, for example, that a company that is in the gaming industry is not actually contributing to the future, current or future well-being of people or the planet. So those sorts of companies are not going to be contributing to the sustainable development goals. But it does provide a broad framework against which we can look at goods and services coming out of a company to map their goodness. It's just one way of many ways, I guess, of addressing this issue. But it's a common language now that's being more commonly used by investors, by governments, by researchers, by academics, NGOs. So it's certainly becoming the framework that is a common framework, I guess, around the world. So that's why we've adopted it.
Excellent. Thanks, Tony. Richard, is this something that Pendal's looking into?
Yeah, I'd love to talk about these. These have really been game-changing for the world, the Sustainable Development Goals. 17 goals, and what underpins them is about 169 or so individual targets. And as Tony said, they've become almost a rallying cry between governments, the United Nations, the not-for-profit sector, and investors. So particularly asset owners, pension funds, sovereign wealth funds, etc., to be mindful of whether or not their portfolios or their assets that they own are actually generating positive outcomes in line with these goals. A couple of interesting things about them. Firstly, these are targets for the world for the year 2030. So they were first established in around 2015. So we've got 10 years left. And it's estimated that the cost to the world of generating these outcomes will be about $30 trillion US. So that's about $3 trillion a year to generate these sorts of outcomes. Now that is a really interesting thing, because in our mind, that provides a huge tailwind towards businesses that are actually providing products and services that move the world towards meeting these sorts of goals. In many respects, we see this as actually a symbiosis, if you like, or two sides of the same coin, generating positive outcomes while also generating strong returns because of that immense tailwind that actually is going to be underpinning our ability to achieve those. We recently, over the last sort of 18 months, we went around the world looking for a team of investors that could build global equities portfolios targeted, buying mission-driven companies targeted towards creating products and services that are meeting these goals. And we did. They've been coming on board over the last few months. The portfolio manager, the head of that team, just started this week in the UK. And in November, we'll be launching in Australia the Regnan Global Equity Impact Solutions Fund, a concentrated global equity portfolio where all the businesses around the world are creating products or services that are moving the world towards the generation of those goals and meeting those targets. A big element of it, like I talked about before, is actually measuring those outcomes so that we can see how we're tracking against it. And in the mind, and this is one of the big questions that often comes up in this space, is if I invest in a responsible way, is that going to cost me returns? You know, that's one of the big questions that often arises. And in this particular case, we actually believe it's probably the opposite. In many respects, there is a underpinning tailwind towards these sorts of businesses over the next decade and beyond that we think actually will create returns.
Excellent. Thank you, Richard. Richard, as a CEO and a product provider, what are you hearing from financial advisors on the ESG, ethical sustainability front?
Yeah, well, I think it's, firstly, big credit to Lonsec for coming out with this approach and what Tony's been developing. And I think what Tony touched on today is the issue that, a lot of people have been talking to us about, which is the confusion in this space. As I mentioned before, that recent Roy Morgan research suggested that sort of 9 out of 10 people in Australia are expecting their portfolios to be invested in a responsible manner. And more advisors are talking to us about clients, and quite often it's their children, or it's actually baby boomers themselves who, have children, who are asking more challenging questions about the nature of their portfolios and starting to be mindful of wanting their values to be expressed through their capital. And it is a very confusing world. So our Regnan team has been supporting a number of groups around the country, talking to them about how they can build out their own responsible investment frameworks and processes and actually empower their advisors to have the right tools to have a conversation with their clients. And I can see the world evolving to moving away from just, say, risk profiling of a client towards even values profiling of a client, and then ensuring that their portfolios are actually, built in line with what's important to them. Because, of course, it's interesting. One of the challenges with giving people advice is that it's not so tangible, and often the payback is over many years. Whereas actually investing in a way that makes people proud and is in line with their values is actually, increasingly important to people. I will say one last thing, Brooke, which is that, some of the fastest growing strategies have been in the sustainable space, and people think that might just be millennials who believe very strongly in this. I know my children won't touch plastic straws. They'll never see, they get outraged if they ever see one. But actually, as we know, they also don't have a lot of wealth. And actually what I'm hearing from a lot of people is that it is quite a lot of baby boomers who are at the point of retiring, who maybe had free education in this country, have had until recently, sadly, 27 years of uninterrupted economic growth, have children who are struggling to afford to buy a home, who are worried about the future of the environment and their ability to raise a family, who are starting to recognise that actually their capital is massively powerful, and it's one of the biggest assets or tools they have to make a difference to the world.
Excellent. Thanks, Richard. Tony, have you got any further thoughts on that topic in terms of what you're hearing?
Well, I just I guess reinforce Richard's point that the confusion. What I'm hearing is people are confused. What does the ESG mean? Why, if I had this ESG fund, is it not got the things in it that I expect to be in it? And so that's really what we're trying to clarify and clear up. Is making it clear what ESG actually means and what it doesn't mean, and help investors go, well, it's important. ESG is important. It's a company that's not looking at their ESG risks, in my mind, just isn't doing their job properly. Just as a company, just as an investor who's not looking at a balance sheet or an income statement, isn't doing their job properly. It's one of the things that investors should be thinking about, because environmental and social risks are changing so rapidly that if you're not thinking about these things, you're probably, as an analyst or an investor, just not doing your job well. But that's just the ESG part, clarifying that to, well, what sort of portfolio do I want, is what we're trying to do with our B score. So we're really trying to make it as clear and simple and provide useful information on the two different dimensions.
Excellent. That concludes the formal part of the session. We've been receiving a huge amount of questions that have been coming through. So please continue to send through your questions. And the first cab off the rank is one for Tony. When Lonsec rates a manager, do they prefer to see the ESG filter applied first to reduce the investable universe, or after a portfolio is formulated?
Thanks, but we don't actually have a preference on whether a fund has a filter or not. Whether the fund is filtered is not going to impact our ESG assessment. So again, our ESG assessment is thinking about the investment process. But certainly a fund that has a lot of filters of controversial things is likely to end up net a fund with a higher sustainability score, because they're going to have less of those bad things in it. So we're not making a judgment that we prefer fund managers follow route A or route B to get to their final portfolio. What we'd like to see is robust ESG processes, and we include that in our rating process, but then we're just going to provide information to clients on the portfolio outcome, and whether that high B score is a result of a filter that was applied at the beginning of the process, or a philosophy that was applied through the process, or a value judgment that was made as a result of growth expectations, doesn't really matter to us. It's what is the outcome that's important.
Excellent. Okay. Richard, any comment there, or would you like to handle?
No right answer here. It's all about, well, it's interesting actually. A lot of, so one of the things we've done, so we offer ethical funds, do no harm. We offer sustainable funds where we're mindful of the sustainability of the companies involved. And then, as you said, we'll be soon offering impact funds directly targeting the creation of positive externalities. We are increasingly offering them through under our Regnan brand rather than our Pendal brand. And the reason for that is that the answer to this, there's no right answer to that question, but actually what's really important is a commitment to this space and a culture and an environment that actually lives and breathes it. And the reason why we acquired Regnan and brought it to be part of our world was because the heritage, the history, I guess almost the authenticity of what it is, we think will get the right outcomes that people are looking for.
Excellent. Richard, would you like to? I've had a few questions which have come through in regards to greenwashing. What is it? And maybe Tony or both of you could talk about how can you stop it as well.
Yeah, well, that's right. Well, there's greenwashing, and now you're getting impact washing as well. So it's everything's getting cleaned. Look, as I said, the this is actually one of the fastest growing spaces. Plus, increasingly, as Tony said, the Lonsec ratings process is going to factor in. A fund manager looks at ESG risks into their existing ratings process. So it's no longer a nice to have, it's a must do. And as Tony said, it should be anyway, because that's what should make better investment decisions. So the truth is that, you know, I don't think a lot of our industry was brought up and perhaps properly trained to think about these non-financial risks. You know, we have an industry full of analysts that are looking at numbers. A lot of these things are subtle, a lot of them are systemic, a lot of them are non-financial. And so I do think that what we're seeing is the industry evolve and develop the skill sets to do this more effectively. While that happens, I think there is a real risk that people pretend to have it more embedded in their processes than they possibly do. Again, this was another reason why we brought Regnan in, to actually have demonstrated expertise as part of our capability set. But, you know, I think as ratings processes evolve in the way that Tony's talked about, as institutional investors become more rigid in their assessment of quality here, you will start to that will be less of an issue. The final thing is measurement. Measurement is critical here. Tony talked about measuring the number of engagement processes or meetings that you might have. This whole ecosystem around sustainability and impact in particular is actually about data and measurement. And you know, there are many of us working very, very hard to improve the quality of that, and that will make it more and more difficult to, I guess, hide behind things.
Thank you, Richard. One for you, Tony. How do you map the alignment between the sustainable goals and portfolio holdings?
All right, so we've undertaken a commercial arrangement with a company in Western Australia called Sustainable Platform, who use a lot of machine learning and a lot of sort of advanced technology to actually filter through companies, filter through all their reports, all their publicly available information, and dig down into what the goods and services the company is making. And then there's a process that allocates it. So we know, for example, that even a company, you know, mining companies, Rio, BHP, they're mining iron ore. We need iron ore for steel. Steel's used in building cities and those sorts of things. So there is a link. It's not a perfect link. It's not a perfect, you know, one-for-one relationship between this building came from this piece of iron ore, but it is an overall sort of a mapping of how the flow through of goods and services are used. So we use them, and we use the same sort of methodology then to do the controversial industries and net them off.
Excellent. Mario, we're starting to run out of time here, so I might ask you one final question, Tony, in terms of what does Lonsec believe is the most important, ESG or sustainability?
Okay, well, they're both important, but they're important in different ways. Lonsec's put out a statement really highlighting how important ESG is in investment processes. As I said, it's critical that an analyst looking at the risks of a company looks at all the risks, not just the balance sheet, not just the competitors, not just the product, but also what the ESG risks are as part of that overall framework. In order to do a proper analysis, you need to be doing all those things. So ESG is important, and the studies, the academic studies, and all the studies are showing that, you know, the better an ESG assessment, or the more ESG is thought about in companies, the more likely those companies are to perform well, or at least manage their risks well, which in the long term is going to deliver better performance. So ESG is important. That's why we're including it as part of our rating process. Sustainability, I mean, in my role, clearly it's important to me, but it's it's important to clients and investors to understand, as Richard was saying, more and more people are looking for these sorts of outcomes. So what we've needed to be able to do is provide a clear, separate report with the information that we hope investors find useful in order to make the decisions about whether a particular portfolio is appropriate for them and their circumstances and their needs and wants. So they're both important.
Thank you, Tony. Thank you, Richard. With that, we might wrap up today's session. We will respond to your questions that you've sent through. There's been a huge response in terms of the number of questions. Our apologies, we haven't been able to respond to all of those today, but we will respond to you in the next, in the not too distant future. There's a lot of them. I don't want to say this week, but we'll get to all of them in the next couple of weeks. For those of you who would like to see some of the other sessions that we've presented over the last 4 weeks, this being the 5th in the series, then you can head to our Lonsec symposium website and scroll down into the agenda and click on the on-demand buttons that are available in there. We really appreciate everyone spending their time with us over the last 5 weeks. It's greatly appreciated, and thank you for your support. Later this week, our team will share the presentation slides and a link to the recorded webinar, for those who don't want to go onto the website itself, and further instructions about how to obtain your CPT points as well. If you have any questions, please send them through to info@lonsec.com.au. Please stay safe, and we look forward to seeing you in person in the not too distant future. Thanks, everybody.